Okay, let's dive right into this explainer and unpack the financial engine behind, well, a seemingly boring waste management company, Waste Connections. You might think trash is just trash, right? You put it on the curb, the truck rolls by, and it just magically disappears. But from a financial and operational standpoint, what this company is pulling off right now is basically a masterclass in pricing power. Today, we're digging deep into their second quarter 2026 data, and honestly, things get incredibly interesting right out of the gate. We're going to explore how a very traditional, heavy industry business is maneuvering through modern economic headwinds to create just massive shareholder value. And if you're analyzing durable business modes, understanding their strategy here is absolutely crucial. Which brings up a really fascinating question. How on earth do you grow profits while physically collecting less trash? Because this is the core paradox of their recent earnings report, and it's exactly what makes this due diligence so incredibly fun to unpack. I mean, think about it. In almost any other industrial business with heavy fixed costs, like, say, running massive, expensive fleets of garbage trucks, a drop in actual volume usually means your bottom line takes a brutal hit, right? The trucks still need maintenance, the drivers still need to get paid, but you're hauling less product. Typically, that is a total recipe for shrinking margins. But Waste Connections, they somehow managed to flip that entire premise completely upside down, turning what should be a painful operational contraction into a wildly profitable quarter. Just to give you a sense of scale right away, get this. Over the last 12 months, Waste Connections saw their earnings absolutely explode by 64.7%. But here is the crazy part. Their actual revenue only grew by 5.6% over that exact same period. Their trailing earnings per share, which is basically the profit they generate for every single outstanding share of stock, reached $4.15 on nearly $10 billion of total revenue. Just take a second to think about the mechanics of that. That massive gap between modest single-digit revenue growth and explosive mid-double-digit earnings growth, that is the absolute heartbeat of the paradox we're looking at today. They're somehow squeezing substantially more profit out of almost the exact same amount of top-line revenue. Now, when you size up the broader industry, Waste Connections sits as the number 3 player by market cap. They're valued at roughly $49 billion, which puts them comfortably behind absolute giants like Waste Management at $91 billion and Republic Services at $72 billion. But the real story here is the valuation. They command a 25x enterprise value to EBITDA multiple, compared to the 18x multiple of their much larger peers. What does that mean in plain English? Well, the market is literally willing to pay a massive premium for every single dollar of profit Waste Connections makes compared to its rivals. Investors are looking at their operational playbook and deciding, yeah, a dollar earned by Waste Connections is simply worth more. And the secret to why they get that premium lies in how exactly they manage their organic growth. The mechanics of this paradox are just brilliant. In the second quarter, they actually experienced a 1.9% decline in physical trash volume. Now, sure, some of this was due to macro uncertainty, like elevated fuel costs slowing down construction projects. But honestly, a lot of it was highly intentional. They literally walked away from low-margin clients. Because they hold such a strong local monopoly in their specific rural and secondary markets, they just confidently pushed through a 6.7% total price increase across the board to their remaining customers. So despite physically collecting less waste, their ability to just dictate pricing drove overall reported revenue up to over $2.5 billion for the quarter. That is textbook pricing power right there. It proves they absolutely aren't just chasing volume for the sake of volume. So the really crucial point here is that this pricing dominance translated directly into a Q2 adjusted EBITDA margin of 32.8%. That's an expansion of 10 basis points, or 0.1% year over year. Now I know, an expansion of 0.1% might sound absolutely tiny at first glance, but that tiny expansion is actually monumental when you realize they pulled it off while getting hammered by rising fuel costs and dropping recycled commodity values. They essentially outran inflation and immense operational friction through sheer pricing strength. Protecting margins in a heavy industry environment when costs are rising is incredibly difficult on its own, but actually expanding them under those exact same conditions, that is exactly what separates a good management team from a truly great one. But, it wasn't just raw price hikes that boosted those underlying margins. Management heavily credited their internal operational excellence. They pointed out that record safety performance across the whole company actually contributed to about half of that entire margin expansion. And why is that? Well, fewer accidents mean lower insurance costs, less operational downtime, and fewer destroyed assets. Then you add to that unprecedented levels of employee retention, which drastically cuts down on the hidden, everyday costs of turnover and retraining. Plus, they're already seeing the early benefits of adopting AI tools for dynamic pricing, and they reported this really impressive 18% year-over-year surge in their exploration and production waste revenue from the energy sector. So they're successfully pulling multiple efficiency levers all at the exact same time. So, how do they actually defend these elevated margins going forward? Well, they're building massive structural moats. First up, that AI pricing tool we just mentioned, it's projected to provide a $20 million run rate benefit by 2025, scaling up to a massive 100 basis point margin improvement by the end of the decade. Second is their renewable natural gas, or RNG, portfolio. They're basically turning captured landfill methane into a highly lucrative revenue stream. Right now, building these facilities costs them money. It's a capital headwind. But by early 2027, it flips into a massive operational tailwind. And finally, their M&A pipeline is still highly active. They've already brought in $100 million in annualized revenue this year, proving they can absolutely still find lucrative franchise deals to buy up. But hey, we have to look objectively at the risks here, because obviously no business operates in a vacuum. The most prominent operational hurdle right now is the ongoing Chiquita Canyon landfill remediation event. They are tracking up to $150 million in cash just bleeding out of the business for 2026 alone, purely to handle environmental fixes. There's also lingering fuel volatility causing some friction. Rapid price spikes caused some volume churn because smaller private competitors reacted much slower to price hikes than Waste Connections did. And looking longer term, their historical dependence on secondary and rural markets means sustained contract growth is eventually going to require greater capital-intensive sustainability advances, like rolling out electric vehicle fleets, just to keep winning municipal bids. It's a really good reminder that physical, environmental assets always carry heavy, unpredictable operational risks. Now, when we analyze their forward earnings, the market is basically pricing in absolute perfection. They are trading at a massive premium compared to standard industry value models, pushing multiple boundaries compared to historical averages. Investors are essentially paying up today for cash flow they expect years down the line. The broader market is fully aware of their operational excellence for sure, and those expectations for continued, pristine cash flow generation and flawless margin execution are heavily reflected in what investors are currently willing to pay. Which means there isn't much room for error here. If management slips up on their AI integration, or if those renewable natural gas facilities face significant construction delays, that premium valuation could correct very quickly. This whole situation creates a really fascinating split in market sentiment, a true valuation dissonance. On one side, conservative models like the discounted cash flow, which just projects future cash and discounts it back to today's value, price the company around $138 a share. They get there by using a modest growth rate for NAPLAT, which is simply operating profit after taxes, and purposefully excluding any future acquisitions. But then you have the bulls. These models factor in aggressive margin expansion, moving up towards the mid-teens to reach a $253 fair value. That bullish stance heavily relies not just on baseline revenue growth, but on Waste Connections flawlessly executing every single one of those complex AI and renewable energy projects over the next 5 years. Which leaves us with this final thought to take away from this explainer. We've seen a company physically collecting less trash, yet somehow making significantly more money doing it through sheer pricing dominance, high employee retention, and aggressive internal efficiency. Considering their undeniably strong fundamentals and their raised full-year guidance to over $10 billion in revenue, here's the big question. Are you paying a premium for truly bulletproof business, or has the market already priced in perfection? It is absolutely the essential question for anyone analyzing the waste management sector today. Thank you so much for diving into this with me, and I hope this provided a clear, structured look into the incredibly resilient financial engine of Waste Connections.